Hi, good afternoon, everybody. We'll just wait for a couple of more minutes for more participants to join in. We'll start at about 1:10. Yeah, we'll just wait for a couple of more minutes. Okay, so I've been given the go ahead to start. Uh, do bear with me. I think I'm having some problem with my video. Other than that, I don't think that there's any issue with connectivity, but I think there's some issue with the video. So do bear with me. So let's look at Neo. Neo is our offering for non-resident individuals, where we are following a dynamic multi-asset approach. Right? It's a PMS. So the minimum as per SEBI is about 50 lakhs. Right, 50 lakhs INR. But we follow a dynamic multi-asset approach. And let's look at how we've been managing this sort of strategy. So we look at the landscape, we look at our strategy, we look at the philosophy, and we look at how our model works of minimizing risk and maximizing returns. Right. So we look at all of it. Right. So our investment landscape is very interesting since we can go from 0 to 100 in any asset class, right, within India globally. We are not having a particular cap on a particular asset category as well. So let's say if we want to do within equity, we want to do more mutual funds, because right now the opportunity, if we get an opportunity to take a basket approach, we take a basket approach. Right? If there is no basket approach, if there is a good mix of passives that we can take advantage of, then we take a passive approach. Right? If there are direct opportunities available to us when we want to be very concise and we want to work on that conviction, we take a direct sort of an approach. Right. So we don't have a particular cap on any asset category, asset class, and we can go 0 to 100 in anything. Right. Now, why is it that we wanted to take a 0 to 100 sort of an approach? Because winners keep changing and losers keep changing. As market cycles evolve, as market cycles take place, longer term and short term, you get opportunities across the board. Now, in places, no, so in market conditions like today, where equity is trading at a very high premium, right? There we would not try to commit more money to equity, where we have that option to go more towards precious metals, which are cheap, more towards debt that is cheap. We can add global, which again, there are parts of global markets that are extremely cheap. Right. So we work on a mix of top down and a bottom up approach, right, where we are able to take advantage of any asset class, and within that any category, and we don't have a particular cap on, say, that we cannot do more than 5% or 6%. No, we can go overweight as well, and that gives us the room to sort of add on to our conviction and keep on adding on to that high conviction, and ultimately that leads into higher returns for us, right? So where is it that we look to sort of invest? One, we are thematic in nature. The strategy does involve thematic investments, where our exposure to high conviction themes that contribute to GDP growth is quite high, right? So we are thematic and sectoral in nature, right? We only look to invest with industry leaders. We back market leaders who operate in favorable industry structures. But to be very honest with you, as since we've been seeing it, and this is in historical as well, usually market leaders don't come to you at very cheap valuation. So we have a valuation band that says expensive, very expensive, fair, cheap, and cheaper, very cheap, right? So we like to start buying and scaling up our positions when it is somewhere between fair, cheap, and cheaper, right? So we start off buying a smaller position, and ultimately we do have a target in mind. Say, yes, we want to, for this particular sector, for this particular theme, for this particular idea, we want to go overweight by a certain amount of percentage, and over time, right, we sort of add on to that conviction, right? So we since it is dynamic, there's a lateral shift between asset classes across market cycles, right? Now this market cycle is such that is giving us that opportunity across all the three categories. Now within equity, there are pockets that are cheap. Within debt, the entire thing is cheap, and except for credit. And in precious metals, to what we have access to in terms of gold, silver, again, that is very cheap, right? So we only look to nurture asset class, and we like to This is majorly a buy and hold strategy, where we wait patiently and try to add on to our conviction, try to participate at each level, to preserve and create wealth. That's our entire endeavor, is one to preserve and then to create and then preserve. That's how the entire cycle sort of works. And then only then we will be able to sustain that sort of consistency in creating wealth. Right. So all you need to remember is, yes, we are thematic in nature. We only like to be with industry leaders that can be within the top 3, top 4, and it's dynamic growth. We can shift across, across asset classes, across market cycles, and consistent compounding is what we are looking to do. Right. Like I said, Neo's investment framework does not have any cap on any asset class. We follow a top down. We'll look at how we are following top down, and we'll also look at some examples of how we have been able to take a concentrated approach across themes where they have been market leaders, and that has worked for us very well. Right. So we look at the top down and the bottom up approach of how we are trying to take advantage of in the market. Right. So if you look at what's been happening, right, this is what how do you build that sort of versatility in portfolios across markets, right? So when we look at valuing growth, we only look to see how we can build wealth for every tomorrow, right? Now, in cases where inflation is high and interest rates are high, we have a scenario where fixed income does extremely well. Right? In a scenario where growth is extremely high, earnings are compounding, earnings are going up, your equity performs well. Now, when you have a scenario like a low growth scenario, but let's say we employ a dynamic strategy, that time multi-asset outperforms. Right. Now we have been able to outperform by having this approach. Since we are dynamic, we can go overweight on equity, we can go underweight on equity, we can go for it. But our entire the way we look to build versatile portfolios is only So I think we're getting some comments about how, because the registration is mentioned retiring in India. See, when we're looking to retire in India, we need to have a certain approach of how we look at retiring in India, right? Now, when we look towards retiring in India, everything is equity biased, and we don't want everything to be equity biased in nature, right? Uh, so this, I think there's some confusion between what the subject is and what you've interpreted. The subject is how can you have a one-stop solution that can do everything for you in one particular product, right? Which is dynamic in nature, which can take advantage of market cycles. Now, as you go forward into this thing, you will be able to see how in India you can take a top-down approach by having a mix of active and passive investing styles, right? It is an NRI specific program. This product is only meant for NRIs. If you're somebody who is an Indian resident, this product is not for you, right? This product is only meant for non-resident Indians. This is very clear that if you want to have an India specific thing, then this is not meant for you. But this is only for non-resident Indians, right? So that clarity, I hope that that clarity is given. This is only meant for non-resident Indians. I think, sir, I think based on my interaction also with all participants here, Neo has been an NRI specific product. And with my interaction with you as well, there has been a lot of conversation that has taken place on both our Indian specific multi-asset strategy and our non-resident Indian multi-asset strategy. Right. So Sphere, I think that's the confusion that's there with you. Sphere is the product that is Indian resident only, where we are taking advantage of a multi-asset strategy, and Neo is more from a non-resident Indian. So I think that's sort of, I hope you have that sort of clarity that this product is only meant for non-resident Indians, right? Sphere, which is our Indian resident dynamic asset, multi-asset product, is only meant for Indians, right? I think now I can continue. Right. So sorry, I'll take you through this slide again. And my apologies, I think if there is any communication mislap from the team side and my side, but this is a non-resident Indian alone product. And everything here has to do only with non-resident Indians and not with Indian resident. Indian residents is a separate product altogether, where we are interacting with investors there on a weekly basis, on a bi-weekly basis as well. If somebody can just give me a thumbs up to say that, yes, I think we can proceed from here on, I'll just proceed from here on. Yes, this is for non-resident only. Indian residents, if you're having ESOPs outside and you want to, if you just want to be part of this to know how our philosophy works, because Sphere and Neo both have a very similar strategy, similar philosophy, similar thought processes. So I think this might give you more insight onto the Indian dynamic multi-asset strategy as well. So if you're interested to know how the strategy works, then you can stay on. If not, I'll meet you on onto the next Indian specific webinar alone. Right. But I do think that you should stay on because you will get some very good insights on this particular philosophy, on this particular strategy. So ultimately, it's going to be your call, right? So now let's move with this slide. So when we're looking to value growth, how do we sort of value growth? Is one, we are only trying to see whether we are able to build wealth for every tomorrow. Now, why is it that we're looking at tomorrow? Because scenarios keep changing, market conditions keep changing, right? So when inflation is high, interest rates obviously go up. When interest rates go up, right, it gives you that sort of opportunity for fixed income to outperform. Then, assuming that we're having a scenario like high growth and earnings re-rating, that time equity outperforms. So when we are looking to build in wealth in India, today debt in India is about 7.5%. Right. If you look at Indian corporates are able to grow their earnings somewhere between 12 and 14%. That's what has happened in the last 5 years. Right. So if you have a mix of growth where you're having dynamic, right. So in periods where equity does extremely well, you can go overweight on equity. In periods where equity does not do well, but your debt is giving you enough opportunity, that time debt becomes that part. So this is how we are able to build versatility on Neo. How is it that Neo is able to take advantage of it? It's simple. When we are having this sort of approach where we're looking more from a top-down perspective, we get active ideas as well as passive ideas. That's how we are able to get a dynamic strategy that works for us. Now, this is the Neo think tank. Now, when we're looking at a particular thematic idea, right, we split it whether it is a top down or a bottom up opportunity that we need to take advantage of. Now, if it's a top down, obviously top down must involve some bit of basket approach where we're able to take a passive approach. And it's an active strategy where we take advantage of investing in direct equity, or we take advantage of direct precious metals investment, and we take advantage of high quality debt like your GSEC right now in India, right? So top down gives us that opportunity to take advantage of active strategies and passive strategies. Passive strategies will be more basket oriented. It will be more from a sectoral thematic. That is, you will get the entire basket. You will get a basket of 20, 30 stocks within that particular ETF, right? So bottom up approaches usually have an active strategy, right? It's direct, and you'll have direct equity and you'll have high quality debt. So when we look at a particular idea, we are always splitting it as whether does it need a bottom-up approach. If it does need a bottom-up approach, then yes, we will look at doing something direct. If it doesn't need, right, which we have done by taking the sort of passive approach. This is why I said that when you're looking for solutions, then you need to be broad based. Then you need to be able to take advantage of every single area as and when that opportunity presents itself to you. Right. So this is a very simple split up of how ideas can be taken advantage of. Whether you're in India, whether you're outside, whether you're in the US, US will have more passive strategies than you will have more active strategies there, because there they are more evolved. There things are more developed. There you have leverage over leverage ETFs. You have a lot of innovation that's taking place there. But here in India, active always comes up above passive. Right. So we have been able to split up, say, yes, let's take a top down, let's take a bottom up. And within top, does it require us to take a basket? If not, then let's stick to one. And how much of it can we go and invest into one? We can go much more than 10% as well. So there we are able to take a high conviction approach towards market leaders. Right. Then comes bottom up. Again, it's the same thing. There it's only active, so it's only high conviction here. That's there. Now let's look at how we took advantage and how you can take advantage of something in India when you're looking to do a top-down approach. Now, when you're taking a top-down approach, like I said, top-down will involve more active and passive, right? It's both, right? Now, in 2018, banks were going through a tough time in India because there was crisis over crisis, and AAA papers were trading at 9.5% sort of yields. Right. So at that point of time, we were able to take a debt call. But what happened to equity at that point was that a lot of NPA started to come up, and the system was seeing a reduction in the earnings pool. Now, when they were seeing a reduction in the earnings pool, what happened was the stock price started to correct drastically. Right. So things started to become very, very cheap on the banking side. So we saw that there was a total industry specific problem that was happening, where public bank and private banks were going through this issue of high NPA, right? And there was a lot of loans that had to get written off, and the government had to support. So there was a lot of recapitalization by the government into these banks so that they can get into much more better shape. They can become much more healthy. Right. What happened after that was they were underperforming. So for 2 years after that, 18, 19, 20, they were going 18 and 19, they were going through some sort of a correction phase. And then 2021, they were going through a bad performance because of COVID. Now, when COVID happened, our banks in India did not go through any problem because we were already getting recapitalized and our books were already getting cleaned up. Right. When our books were already getting cleaned up, from a fundamental perspective, your return ratio started to improve. That's when we started taking this call that this entire sector from a top-down approach has sort of bottomed out. Now, we have to add some sort of conviction onto this top-down approach, either by having a basket approach or to be concise and have an active strategy by just doing a couple of stocks. What we decided was, no, this requires us to take a basket approach, and we were able to take a sectoral ETF that was available in India, which was public sector banking with it. Right. So what Neo does is that we don't buy everything on one day and sell everything on the next day. Right. So every portfolio that is getting built here in India, and that we are building here in India, is all opportunity driven. Right. And it takes us time for us to build that sort of position. So it has taken us 1.5 years for us to actually build a very high conviction position of about 10% odd. Right. So it took us time. So we were buying slowly and slowly and slowly. And this is all opportunity driven. So let's say today you say that, yes, I think that for me, my retirement solution in India is new and I want to start, onboarding. You might not have the same portfolio as what we've been building for the last, for somebody who came in 8 months back or 9 months back, because at that point of time, the opportunities were different. And today the opportunities are different. So you will never run out of ideas, number one. And number two, you will always be able to participate in newer ideas and older ideas, because some volatility might come in, things might change, right? So you will always have a different portfolio than somebody who came in a couple of months back, right? So here what we were able to do from a house approach is that we were able to have 10% off for all the investors who came in onto Neo, because things were cheap for 1.5 years. And after that, what started to happen was that public sector banking sector started to do extremely well. So for 2 years consecutively, they were delivering 60% odd absolute return, and then things started to look extremely good. So we started to see that yes, does this warrant an exit or not? So when we decide that yes, this is the time for us to take that exit, we still take time to exit. It's not that we exit everything in one day, right? So staggered approaches in and staggered approaches out is what the think tank sort of yields for us. Right. When we start buying, we don't buy everything in one day. It takes some sort of time. We build positions slowly as and when we keep adding onto that particular conviction. And once the entire thing sort of plays out and it becomes a lot more expensive, that's when we look to say, yes, this is not something that our investors can take that risk. And that again goes into another idea that can yield very high returns by taking on lesser and lesser risk. Right. So it's more from a, is there a point where things are becoming extremely risky? Yes, then we take that call, say yes, let's slowly take a staggered approach to cut our positions, and then take that call to say yes, we are now walking away, and we are moving on to other ideas. So but majorly we are buy and hold. We've had a good churn now that has come in, but apart from that, it's majorly buy and hold. Now, what did we do on the GSEC side? This is more on the debt side. Now on NEO, we are able to take a debt approach via ETFs. Right now, we have not taken that approach. We are more on the shorter term side, more on the liquid side, right? But this is what we have done, in our history, where we were able to take this sort of AAA at 8.5%, 9% during the INFS crisis. And right now we are trying to focus more on the longer term side, because in India, debt is longer term debt, which is much higher than your developed nations, is somewhere between 7.5, 7.6%, right? And we are in a scenario where interest rates have peaked out. So even a 50 bucks cut would actually lead us into getting in about 12% a year. And then eventually, if we do hold it for the 3-year period, because we would like to hold it for a 3-year period, that would again lead us to make about somewhere 8.5%. So it's a good mix, and it's a good healthy mix of debt, precious metals, global, as well as Indian equity, and sort of global equity. Right. So we are not averse to taking any global debt as well on this particular portfolio. Right. So wherever there is opportunity, we will be present there. Right. That's what sort of NEO does. So in debt, we've been able to take a AAA, we've been able to take long term again, and we've taken a floating between 2020, 2022, which is now starting to work up extremely well, right? But newer and newer opportunities are coming up on the debt side, much more attractive than that of equity in India. Right. So how do we compare ourselves to our returns over the past 1 year, 6 months, and since our inception? So in India, there are so we are benchmarking ourselves towards multi-asset mutual funds. Our official benchmark is the multi-asset index, but internally, we do see us comparing ourselves to a FlexiCap product, which is 100% equity oriented. Because when we benchmark, we need to know, are we doing much more better than a 100% or 80% or 90% odd equity product than us, because we are not taking a 100% equity call at all, right? And if you look at us from inception, we have not had a 100% equity scenario, though we've had high equity over 75%, 76%, right? And the rest has been in precious metals, global, and debt. This is from a house perspective. Right. But what has happened is, since inception, we have been able to outperform your multi-asset fund, which has strict mandates of having a fixed asset allocation to equity, to debt, and to alternate asset classes. Right. And you have FlexiCap, which is having 80, 90% or 75% or under. That's the minimum, right? 60, 75, 60 to 75 is what they would have in their equity. And that also we have been able to outperform from that perspective, right? So if you look at us from a 6 month, 1 month, 1 year has been somewhat of a lagger. But when we are building portfolios, we are not building from a short-term perspective. We are only building portfolios from a 5 to 7 year horizon, right? And this product does not have an exit load also. So when we are looking to when you're looking from a liquid perspective, there is no exit load. You can exit whenever you want to, and we've kept the cost also extremely low. right? But the whole endeavor is that we are only trying to build wealth in avenues that give us good opportunity by having a dynamic multi-asset sort of strategy, where this strategy is able to outperform even a high equity driven product like a flexi cap or a large cap or small and mid. We have not yet done small and mid as a comparison, but over time we will continue to do it. And like mutual funds, we have kept this product also extremely simple. Simple is what we are looking to do, and this product would also be able to take up SIPs. Right? The best way where you can sit and see, how is it that we're able to handle drawdowns? Something bad happens. What is it that what is it that you stand to lose? This drawdown is as of 31st March, but updated data also shows that it's around the same place. And one interesting data is that internally we had a question being asked by the team because in India the election results led to extreme volatility in the market, and we did see the index go down by 5-6%. How much did we go down by? We went down by 3.6%. Right. Since we don't deploy everything on day one, our day one deployment stands to be somewhere between 40%, which means it takes us time to sort of build portfolios for you, where it takes us 4 or 5 months to sort of build that entire 100% into, where we are desired to, where our desired allocation is. Right. It would take us this sort of time. Right. But from a historical perspective, since inception, our drawdown has been somewhere around 4%. Your multi-asset has been 5%, and your Nifty has seen a maximum drawdown since our inception of about 10%. Right. So we are able to make more than your pure equity products. At the same time, we are able to manage significant volatility since we are taking much lesser risk. So the quality of our product is significantly higher than what you're able to get from a mutual fund as well as a passive product like a Nifty 50 benchmark. Right, because in the US or rather in developed nations, ETFs work very well because it's somewhat efficient. But here we can take advantage of anomalies in the market, and that can only come with active management. What we have done is we have gone one step extra because we have seen the power of how passive investments have worked, particularly in sectoral and thematic funds. Right. So we will not take a broad-based approach towards the market. We don't do futures, options, nothing. We will not take a broad-based ETF also that is more Nifty 50 oriented or 100 or momentum based. It's a pure active management fundamental oriented product. Okay. The way we positioned is right now, we are more overweight towards the financialization story, which means we are more overweight on financial services, right, which are market leaders. At the same time, we are well protected in terms of any volatility that comes up because we have adequate allocation that goes into debt and that goes into precious metals plus globe. Right. So whatever volatility is able to come up, we are able to shield it because we are having some allocation that goes into precious metals as well as liquid. Right. So we are not fully deployed. So we are always going to be this sort of we are always going to be all weather. Right. In terms of risk, what your expectation should be in terms of this particular solution that is being offered to you as a retirement solution is that we operate somewhere between conservative and moderate. Now, why we are operating in the middle is because when we are able to take an outlier call on liquid or cash, that's where our conservative sort of comes in. And because we are patient as capital managers and wealth managers, we are able to get good amount of opportunity into market leaders at very cheap valuations. So when you're able to get that, then it's the best that you can get in India when they are a market leader and in sectors that are poised for a turnaround. Right. So we are operating somewhere between conservative and moderate. So if you are moderate as an investor, but you still you want to make good amount of returns building wealth in India here, having that expectation of average inflation plus 5 and 7%. Right now our average inflation somewhere in India is about 4.5-5%. Our expectation is that it will be somewhere around this level. So if you are having that expectation that you want to make somewhere around 12 and 15%, this is that product for you in India. As we are able to grow at much higher rates right now, but from a normalized basis, a multi-asset strategy grows at about 9 and 12. Our aim is to grow somewhere between 12 and 15. Right. So if you're able to grow at 12%, then you're doubling your wealth in India every 7 years. Right. So every 7 years is what you should be looking for if you're able to grow somewhere between 12%. Right. So and if you're somebody who does not want to take much risk, but at the same time want that extra return, this is that sort of product for you. Right. So our promise is that what you should see is how we are able to sustain wealth creation. Right. Forget about creating, how we are able to sustain wealth creation, because that is the strategies that we are employing here to protect you against any uncertainty and volatility that keeps on coming up. And that's how we've been able to do right now, since our drawdowns have been much lower than what other products have actually had. Right. What you should be seeing here is our ability to sustain wealth creation for you. Right. This is just some numbers. Since inception, we've done about 30%. And what you should be seeing is right now from an equity perspective, we are having about 70. This is from a house perspective, overall perspective. 76% is in equity. Precious metals is a high weight of about 13 to 14%. Our expectation is that this weight will go up. Cash is about 4%, and the rest is in debt that is short term, that is more liquid in nature. And we are able to take some global calls, and the global calls are not your pure play. We are able to take some high conviction bets in Asia as well. Right. So wherever we have that allocation that we can do, we are able to do here in India. Right. Our currency is depreciating. Is historical levels of depreciation have been somewhere around 3%. But our expectation is that Indian currency would strengthen over time in the next 10 years, because we are getting in a lot of flows. Indian debt is getting included in the bond index, which is again $25 billion worth of foreign annual flows that can come into our system. Our forex levels are extremely high, so we are able to manage our currency levels, and our structural deficits are coming down, so we are not having that high of physical deficit, which means that yes, things are looking good here on India perspective, and we are an 7.5-8% growing economy, which no other economy is actually providing to the world. So with that in sense, right, it might not be 3%, it might be lower. So our expectation is that the depreciation levels would start to come off in the next 10 years or so. So currency, that question is addressed. Right. So minimum investment of 50 lakhs. We have a fixed fee model. There's no variable. There's nothing. It's just our management fees that we're able to cover. All the gains are yours, and everything comes in from within the portfolio only. So our dividend yield is somewhere about 1.4%, which is covering for your fixed fee. Right. So all the gains are yours. This is for somebody who's 5 to 7 years with moderate risk appetite. Like I said, we can go 0 to 100. There's no problem at all for us. But our benchmark is a multi-asset index fund, where they do their equity with the index 50% equity, 40% arbitrage, and the rest can go in REITs and invest. So we do have that option of going into REITs and invest. We have not yet taken that option right now because we are looking at other options, but we do have that option. So it's completely open, opportunistic sort of strategy that we're employing. Right. Just something about the team. This is our team, and it's the CIO of this, and the fund manager is Sham sir, and he has about 30 years of investing experience. You would have seen him on YouTube. You would have seen him for the CFA Society events. You would have seen him everywhere. He's very, very active on Twitter. His views are he's very, very active, very candid on Twitter as well. So he has about 30 years of experience, and he's also the manager of our FlexiCap product, which is Solitaire, which is our flagship product, and the Indian dynamic multi-asset strategy called Sphere. And he's co-fund managers with Rohit and Rajat, and Balaji sir, who is our head of research. Rohit and Rajat are our small cap fund managers, and they have a very they have enough experience, about 10 years of experience in the entire industry, 10 to 13 years of experience. They worked with Rakesh Jhunjhunwala's family office, plus they've been part of private equity as well. So since small cap does work like private equity, their returns also are much more higher, right? True Blue is our only large cap product where you will just have the creamiest of the creamy in the large cap space, right? We have a strong research and strategy team. It's about 15, 16 members here. So we are completely a research oriented organization, and everybody here works individually on each portfolio. The research team works on getting in the newer ideas, maintaining the existing ideas, and the strategy team here is in charge of making in that particular allocation and deciding how much of what to put in a particular portfolio. Right. So this is our entire team. Cover that. Now I think I'll open the floor for Q&A if you have any questions. I've put in the number. If you guys are interested, just send us a hi, and somebody from the team will definitely get in touch with you. So if you have any other questions, if for something that I have not covered or you want something to be covered, please put it in the chat box here, and I'll do my best to sort of address it. So this product, so the service has been there since 2013. Now we started about 13, 14 years back, and it was part of the advisory service. But so what happened with the advisory service was that from an industry perspective, it became very difficult to sit and operate it because of approval. So operational efficiency was very low in the advisor service. We were managing about 420 odd crores in the advisory service in India. But since it became operationally difficult, the larger players like IIFL and Motilal shut shop in the advisory space, and we were trying to survive. So it became very difficult to survive, and operationally it was becoming very, very inefficient, right? So we shut that, and this is what we were doing in the advisory service for our advisory clients. So once we shut that service, we returned the money back to our investors, and our PMS business started in 2019. So Solitaire, which is our FlexiCare product, is the oldest product, and this product, along with the Indian product, manages about 500 crores. So the Indian one is going to complete 3 years now, but the strategy has been there for the last 13 years, right? Because we were doing the similar strategy in our advisory service, but since we were shutting that and we were already having good PMS business, so we sort of basketed this service to our investors, right? But together, the entire dynamic multi-asset product manages about 470 crores, and the NEO's contribution, which is only NRI specific, is about 60 crores. So NEO has started it 2 years back. NEO as a product, as a simple product, is 2 years back. Yes, the minimum is 50 lakhs. How can an NRI transfer funds? So we will open an account for you here in India. Unless you have an existing demat account, we'll have to see where your demat account is. And once, if there's no problem in terms of account opening, we will open an account here for you. We will take care of the entire account opening process, and then you can transfer funds here. Everything will be in your name. Everything will be in whatever PAN name that you're doing. It'll all reflect in your NSDL. Nothing will be with us. We'll just open that particular account for you and start the discretionary PMS here in India. Minimum is 50 lakhs. Yes, this is all SEBI mandated. You missed the part for forecast of rupee versus dollar. See, what the outlook is that in a scenario like US where inflation is high, Yet we are seeing some good growth that's there. But the growth is not well distributed. It's just, I mean, from parts, right? But the inflationary cost is very high, and that has actually affected them very badly. Now, in a scenario like this, you're not supposed to have a currency that's extremely strong. What has happened is that all the other currency that are pegged to the dollar have weakened. If you look at Japan, if you look at, there was a period where the pound was not doing extremely well. So in that scenario, it looked like the dollar was strong. But inherently, if you look at the dollar index, it has been weakening and it is weak, right? India's fundamentals are extremely strong right now. So we are expecting India's next 10 years to remain extremely strong, right? So historically, India has depreciated somewhere between 3% per annum, right? What we might see going forward is that would sort of start to come off, right? It might not depreciate as much as what it used to depreciate in the past, because at that point our fundamentals were not very strong. Today we are in a very strong fundamentally. Our structural numbers are extremely good. If you look at our tax collection looking very good, deficit looking very good, inflation not very high, growth only country that's giving you that sort of growth. So we are expecting that we might not depreciate as much as what we did in history. So there is a good chance of appreciation that's there. 2 years, what is the return? How is the portfolio size increased as products? This is our return since inception. We started on 17th October 2022 as this particular product. The last 1 year we were able to 38%. Last 3 months have been over 8.7%. On the Indian one, same thing has been somewhere around 9%, 9.8. Right. How has the portfolio size increased? I don't know what that means, but from my understanding is that the size of this particular product is about 62 crores, right? Our Indian one that we are managing is somewhere between 420, 430 crores. So together we are somewhere between the 500 crore mark. The entire dynamic multi-asset strategy is about 500 crore mark. As a house for PMS, we have crossed 3,000 crores. As a house, we have crossed 3,000 crores. Management fees is 1.5%. Management fees is a fixed fee, 1.5% per annum that will be calculated on the NAV, which will be charged to you quarterly. So 1.5% per annum will be charged to you quarterly based on the NAV. Right. So including GST, if you add GST and all the other sort of costs, it would be 20 years, I believe somewhere around 1.7%. That's it. Right. We have kept it very competitive because India mutual fund AUM of 55 lakh crore, right? And as the size goes, your expense ratios also will come down. So we've kept it very low for a particular reason, because we do understand that this is not a strategy that it's a very simple, good, stable, consistent strategy that is able to give you, is able to take lesser risk, be less volatile, at the same time give you high returns. And our expectation is over a very long period of time, we just want to grow somewhere between 12 and 15%. Right, multi-asset strategy totally, right, historically has done somewhere between 9 and 12% on average. Your Nifty also does the same. So when you're able to do much more better than your broad-based passive indices by taking on lesser risk, because that is a 100% product, and you're able to do much more better than an active strategy where they have high allocation towards equity, fixed high allocation towards equity, and we're able to do much more better than that, then yes, it makes sense for somebody who has that sort of expectation from us, where their expectation is that yes, I want somebody who can sustain my wealth creation in India. Right, so we have kept it fixed at 1.5%. There's no profit sharing. There's nothing of that sort. There is no exit load also. So on our other products, there is on the Flexia product there is an exit load, but here there is no exit load. And the management fees will be taken from within the portfolio. You don't have to pay anything from your pocket from here on. No, SEBI is 46 crore, nine. PMS service is 50 lakhs only. Minimum is 50 lakhs. We have been operating since 2019 on the PMS side. No, 50 lakhs is the minimum ticket size. Yes, please do. No, that is the, oh sorry, that is the old number. No, we have still have to put it outside. 56. I have the number. We crossed 50, so it's about 56, 57. The market values keep changing. So yes, Sphere webinar would come in. Do follow us on ithought PMS on the official website. Wherever you are sort of following us, you would get that sort of information. And just send us a hi also on this particular number, and we'll keep you in our marketing list, and you'll keep on getting uh, information from our side. Right. See, when you want to cross check any PMS service, see, APMI is good. You can go to the APMI website, which is the Associated Portfolio Managers of India website. It's again, it's updated only, I think so. You can just check there. And there is PMS Bazaar, but APMI is like the new thing. So APMI is good for you when you want to check other PMSs as well. And from our side, you will get monthly, you will get your statements, whatever we have done from our side, monthly, that comes to you via email, plus every quarter whatever communication comes from our side via quarterly letters. And already you will be part of the webinar system, so you will have a lot of one-on-one discussions with us as well, regarding your particular portfolio, how we've built this particular portfolio. Thing is, with this particular product, right, we've kept this product for to scale, which means that since we are not going to run out of ideas, right, it's not a model portfolio, right, it's something that it's based on opportunity. So we will always have ideas to invest in, new and old. So your job only becomes to consistently keep saving, and consistently keep saving in a particular vehicle. See, in US, there is 401ks, right, where you just keep putting in your money and they'll manage it extremely well. Now, that's what we had an endeavor of when we started this multi-asset strategy, to say, because yes, it's dynamic in nature, but there should be a vehicle in which investors can consistently keep contributing. Right, they are saving this. They should use this as a savings vehicle that is able to grow at good rates, at the same time, not have too much volatility. Right. So 401ks work like just like that, where they're just contributing consistently, and here you should contribute consistently. Right? That's what the endeavor is. That's how you will be able to take advantage of all ideas, new ideas, and old ideas. Right. Systematic withdrawal is available in PMS. See, we can formulate something for you, right? We can formulate something for you where you want some sort of systematic withdrawal. So we will plan for you, irrespective of whether it is in a PMS, or whether it is, or we are building wealth in PMS and then taking it to, MF, where its liquidity is much easier. That we will plan for you and do it just for you, tailor made for you. So we can plan for that. You cannot pledge and do option selling. So you can do so we can, so it's a discretionary payments. We will just be doing where to invest, and taking over the execution. But I mean, I would suggest you not to do it. But anyway, the holdings are with you. So and we don't do any option selling, we don't do any futures, nothing like that. It's just a simple product. It's a very simple strategy that is foolproof, works in all market conditions. We have seen it work in all market conditions, and it's foolproof. So we just want a very simple product. No, we will open. So how this works is that we will take all the relevant information from you. We'll do your KYC. We'll do everything. It's an agreement that takes place between the both of us, right? Since it's a discretionary PMS and regulations are quite high, you will get a complete onboarding, toolkit. You will get the agreement. You will get everything from our side, and we will open an account with a bank. We will open your broker account and the custodian account. So we will do all that from our side for you. And once that is done, uh, once you are able to transfer the money to us, we will take care of the entire investment process. And you can only keep transferring to that particular that particular account, whether you want to do, on a weekly basis or whether you want to do monthly SIP basis, however you want to do, that is for you. But we have to start with the 50 lakh. Right. And hoping that everything here in India is, everything here from an operational standpoint from your side is that there is no hiccup. Then the account can open and get running within 7 to 10 days. So since it's a discretionary PMS, we will take the entire execution as well. So you don't have to do anything from your side. You will get monthly statements from our side, and it will already be reflecting in your NSDL statement as well. So everything will be in your name. So for Neo, it's HDFC. HDFC is our custodian. They are not a broker. Our broker is Spark Capital. And for Sphere, which is the Indian one, custodian is ICICI Bank, and broker is Spark Capital. So if you are an NRI having HDFC account, then no problem whatsoever. The PIS is the same, so it will not be a problem at all. Anything else, then we will have to sit and see what we can do for you. Whether you can do it in somebody else's name, but whatever the case. Sorry. So the custodian will take care of the entire fund accounting process. So what we are buying, selling, everything has to be accounted for, right? So everything that it's the custodian does the entire fund recon and the fund accounting, right? 1% of annum. See, that is what you put. Like, let's say if you're putting 50 lakhs, and that 50 lakhs in 1 year has been growing. It's grown to something, right? So on the net asset value is what we will calculate the fees on, not the total AUM for new. Right. AUM is your asset under management. So what you have put, right? What your ticket size is basically what we will charge you on. Thank you all so much. We'll keep the floor open for another minute or so. If you guys have any other questions, I'm very happy to address it. But do follow us, do send us a hi here. Somebody from the team will definitely get in touch with you. And depending on what your requirement is, we can tailor make something for you. Get on to just send us a hi. We'll put you on, our entire communication channels, and you will get all the information regarding Neo, regarding Solitaire, regarding True Blue, Vriddhi, and as well as Neo. Right? So you can make the best choice that you deem fit. Thank you so much for joining in. Have a great weekend ahead. I'll see you guys sometime next week. Thank you so much, guys. Thank you. India is bullish in the next few years. Why do I need to select a conservative? We are not selecting a conservative approach at all. Neo is not run just from a conservative mind. Conservative means that where is it that we can take that risk? That doesn't mean that we're not taking risk at all. Risk is being taken. That much I can tell you. Where is the risk being taken is what is where the conservatism starting to come, right? So if just because things are bullish doesn't mean that you should not be little risk averse or have risk management checks in place. If that's why when we compare ourselves to 100% or a high equity, which is considered to be quite aggressive, our approach is still able to do much more better than them, right? So that's why when that slide came for moderate to conservative, it was in the middle. So because there are times where we are able to take extreme risk, there are times where we can take low risk. We are not fixed to even taking that, right? Unlike a fixed mandate product where they have to continuously keep taking risks no matter what the scenario looks like. So we are just taking risks somewhere else. That's it. It's not that we are trying to do what the herd is doing or trying to chase money and trying to chase trends, but we are going ahead of the curve and taking risks in avenues that is not herd. It's contrarian in nature. We are just being conservative in how much we want to pay for a particular business or pay for a particular idea. That's it. That's all. And I think that sort of conservatism is required in today's market. See, today's market is such that Indian investor has plowed money into mid and small caps the last 3 years, right? Your gross flows that have come in the last 12 months have been somewhere around 80,000 crores. Net has been somewhere around 40. So a lot of money has gone into and riskier assets where investors are willing to pay higher and higher uh, for for that particular business that is still yet to grow. So it does, you need to be a little conservative in terms of valuations. That's it. Your risk on approach always must be there, but conservative in terms of valuation. That's it. No, our broker is Spark Capital, Chennai. Yeah. Market is touching a higher high. No, you're not missing out on anything. See, when we are also trying to build, positions here, we are only trying to build positions where the opportunity is high. So, like I said, we are taking risk. Where is it that they're taking risk is what matters. There are pockets of the market that are still undervalued, right? Within equity, then the other asset categories are still cheap. That's the beauty of us having a multi-asset and a dynamic strategy, right? For us, it doesn't matter if the markets are reaching all-time highs, because you will always have pockets where market leaders are undervalued, right? Where there is some good amount of turnaround that has to take place there. So we will always have that option. We will always have those opportunities. Like for example, in when we started this portfolio, we were more infra oriented. We were more infra heavy. Today, the portfolio has transitioned a lot from infra and commodities and public sector to financialization, which is more financial services oriented. It's more broad based, right? More consumption oriented companies. So we will always have pockets where we will always get these pockets of opportunities, right? So you will not lose out on any opportunities going forward. Even if you sit on some cash, it's good that you're sitting on some cash. We will take that cash call for you, so you don't have to worry about that at all, right? What I can tell you from what we will do as capital managers is that we will take a conscious call to be tactical in terms of participating in the market. That's it. So when things are not looking very good, our participations you would see is extremely low. Like for example, in June, so for the Indian multi-asset strategy, right? Since that's slightly more that's slightly older than this particular product. In June 22, we got that option to, the market was going down. And at that point of time, our participation levels, they were about 95%. So today, day one deployment is just 40%. So always we will have 40-45%. We will always have that sort of opportunity to invest in. So and we have seen staying in cash and then participating and then still staying in cash. This is not a buy, sell, nothing doing. It's just, yes, so we are working very hard on each particular portfolio to say that, yes, the cash levels for you are here, and this is what we are looking to do. So do support us in any way wherever you want to participate. If you are having some bonuses on your side, please do participate. That's why we are always looking to do SIPs, because it's much better. Then we will not lose out on any opportunity in terms of building in a newer ideas, newer themes, or scaling up on existing ideas, so that this way you are also not missing out on it, right? So we have seen that transition take place from high cash to low cash to high cash again, and participation levels going up as market volatility goes up, down. But we are able to take care of deployment. So when the time for us to comes in, when we are able to take care of that deployment, we are taking care of how much cash to have, how much cash not to have. But the beauty of this entire strategy is that it's wealth for every tomorrow. It works in every single market, no matter how high or no matter how low it is, because we are able to position in undervalued parts of the market. That's why we're being conservative. But we are showing our aggression in terms of building in high position sizes. So public sector, for example, was a 10 to 12%, 10 to 12.5% sort of position, which is a high position, right? So if you ask me if I was going to build something right now on this particular avenue, obviously I would be a lot more conservative than what I was back then. So the whole team says no, we will be conservative right now. So it's not one person, it's always a team that sort of goes out and take that decision. Do I have a separate? No, Sham sir is the portfolio manager. The team, there is a team that works day in and day out, and I'm also part of that team. The strategy team, that is, the head of our investment strategy, Niranjan Sridhar, Samyukta, me, we all work for the dynamic asset, multi-asset product. And so whatever happens, It's his decision no matter what. The veto is all his, and we are making sure that you are well adequated. You have enough position in that particular idea to make sure that yes, we are in the right place for you. And if there are, let's say, like, somebody was talking about how there must be, can you plan for an SW? There are certain plans that are taking place. Then that particular portfolio will be managed in that particular way by the entire team, where the fund manager will completely be Shamsar, where the decision completely will be taken by him. But the entire research work, the support that would be given to him would be from our side. But the decision completely his. The direction that he will give is completely his. So will you have more different kind of stocks within the portfolio based on entry? See, when you participate, so we have a set universe that we want to work with, right? So as your participation levels start to go up, we have opportunity to add on to as so if we were taking a household to say yes, we want to start buying in on this particular product or this particular idea, then we would take that call, say yes, let's see if we can incorporate that based on opportunity for that particular investor, right? As you participate more, yes, we are able to take that option for you. Now when we decide to take, so for somebody who is not able to participate more, somehow we will try to incorporate it, because there the since we are our conversations are happening one-on-one with the investor as well, we know as to how much they can sort of contribute. So again, tweaking would happen there, right? So we would just be able to tweak in and out. This is not buy and sell, but we would be able to tweak, say yes, we would prioritize something more than we would prioritize something for you, right? So priorities would be given specifically for you based on how your potential is, what you want to do, how you want to do things, based on your participation level. And ultimately at the end of the day, we make sure that everybody is able to participate in some way or the other in that particular idea, in that particular product. But it depends on them, right? So priorities, it would be prioritized in a different manner for them than it would be for you. It would not be different. It would not be many, but yes, there would be a good amount of difference that can come in. So right now we don't have a long tail. It's just about from a fund perspective, it's just about 20-25 line items. That's it. So your question is, if you entered, you allocated based on the previous portfolio, or you wait? No, no, fully based on your particular portfolio. Now, let's say if I want to add 5% in a particular business, and I say, okay, today I want to add, today the allocation is, yes, we are getting a good option. So to say 3%. See, when we exhausted, like if there's a cash call, you would get a cash call from our team, whoever is assigned to you from a relationship manager perspective, he would get in touch with you to say, see, we do have some ideas that we want to buy. Existing cash levels is little inadequate. So if can you kind of give us, or do you have some more parked that have that you can participate at these levels? If you have it, then yes, it would come in. If it does not, then the priority for you would be changed then. Right. So based on that particular portfolio for you that we've been able to build, we would be prioritizing products and ideas within your particular portfolio. Buy and sells will only take place when the idea has played out. Now I'm able to show you publish setup because that was a buy and a complete sell off totally. So our churn has just been about 30 odd percent since our inception. That's it. So we've not churned a lot also. So full exits is what I'm able to discuss with you. Yeah, and the thing is that we are not able to give you individual returns because their risk appetite is different. It's built completely different for them, right? But there will not be much difference in what we are building for. So if let's say if we take so for example, right, 10% odd is what we had decided to do public sector. So as a house, because it is a high conviction bet, right? Where we are able to build 10%, we would build 10% completely. Right. There were just a handful of accounts where we were able to build only somewhere between 7.5 to 8%. That's it. So that means that yes, we are able to build a higher allocation to that. It's just that somewhere between one or two accounts here and there, it would be lower. Right. But when we're taking a house call, we ensure that hook or crook, one, there will be a time where there will be some allocation that goes into this particular idea. Right. Now, let's say, for example, you are not able to participate. You are able to participate, we would start building that flow. Somebody who's not able to participate, we have to wait. When somebody is not able to participate, we have to run with that particular existing workflow, and then we have to see, we have to prioritize based on that. Now, if I have 4 ideas, I can prioritize only 2 for somebody who cannot. But for somebody who can, I can prioritize all the 4. Right. So allocation would be there to that particular idea, to that particular product. It's just that it might just be lower than what it is or higher than what it is. That's it. Right, but individual level, I cannot share. But when we have an annual review or an annual project, so when we complete 2 years, we will have a good webinar for 2 years. And in the last for the Indian webinar, I had put out where most of individual portfolios lie, just to be very transparent. So maybe at that point in time I can share, but that's not how we put out data outside, but that can come in only when we're having an annual sort of a review, when the as the fund keeps on completing number of years. At that point of time, I can have a very transparent conversation on that. But when we are reporting on a monthly basis, there I cannot report individual portfolios because everybody's thing is built very different. So more or less anybody who came on 1 year back, right, they would be around this 38% return. Yeah, they would be around this 38% return. So when the annual review happens, then you will know where the subset lies, because this is not it will just be around this number. So when that review happens, that's when you will know, you'll get the exact number then. So fees is already included in this. So this is that number, and this is the May number. This is 31st May. If you wait for another 12 days or something, I think on the 5th, maybe on the 5th of July or something, all the numbers would come in even for June. So you can check even the June number. So we are publishing all numbers on a monthly basis only, and you can look at APMI, you can look at SEBI. APMI is more updated. You can look at that. So and or you can look at PMS Bazaar also. So there is no that much I can tell you, that there's no that the number is correct. The number that we have to publish is correct. Because this is not number that we are calculating. It's coming straight from the custodian. So like I said, that custodian will do fund recon and fund accounting. So it's coming straight from there. See, my fees already comes into the current value. So it is all included. It already comes in. I think I have time for maybe one more question, and then we can sort of close. And if you have further questions, then I'm very happy to do this one-on-one as well. So just send us a hi on this number, and whatever other questions that I'm not able to take due to time constraints, I can definitely have a one-on-one call with you with the team, no problem. Thank you so much for your time. Thank you so much for your support and participation. It was a very fruitful conversation. Thank you all for whoever stayed on. Have a great weekend again, and just send us a hi on this number, and we can again get on a discussion with the team. No, thank you so much, guys. Thank you.